Before we dive in, please remember that I am not a licensed financial advisor or insurance professional. This video is for informational and entertainment purposes only and should not be considered legal or financial advice. The world of insurance is complex and varies greatly by location and personal circumstances. Always consult with a qualified and licensed professional for your specific needs before making any decisions. Imagine this: you're packing the car for a weekend trip. You're heading north, maybe to see Niagara Falls from the other side, or to catch a Blue Jays game in Toronto. You've got your passport, your snacks, your playlist is perfect. You cross the Peace Bridge from Buffalo, or the Ambassador Bridge from Detroit, and suddenly, you've entered a parallel universe. A place where the rules of the road feel the same, but the financial reality of driving is completely alien. Because what if I told you that the person in the lane next to you, driving the exact same Honda Civic as you, is likely paying more for their annual car insurance than you paid for your last family vacation? Not a little more. We're talking double, triple, sometimes quadruple the price. Welcome to Ontario, Canada, home to stunning natural beauty, vibrant cities, and the most brutally expensive car insurance in all of North America. It's not a myth. It's not an exaggeration. The average annual premium in Ontario hovers around $1,600, but in some cities just outside of Toronto, like Brampton or Vaughan, a young driver with a clean record can easily face premiums of $5,000, $6,000, even $7,000 a year. That's more than $500 a month. For a basic car, that's more than a luxury car payment in most of the United States. Meanwhile, just a few miles away in Buffalo or Detroit, a similar driver might be paying a fraction of that. So why on earth should you, a driver in California, Florida, or Texas, care about a Canadian province's insurance woes? Because understanding this broken system is like getting a cheat sheet to understanding your own. By dissecting why Ontario's auto insurance is a financial meat grinder, you will learn to see the hidden machinery behind your own policy. You'll learn to spot the red flags, to ask the right questions, and to understand the forces that are secretly driving your rates up, year after year. This isn't just a Canadian story. This is a masterclass in becoming a powerfully informed insurance consumer, using our northern neighbors as the ultimate cautionary case study. So what is going on up there? What creates this perfect storm of wallet-crushing premiums? Is it the snow? Is it the healthcare system? Do they just have way more accidents? The answer is a fascinating and complex cocktail of private industry ambition, heavy-handed government regulation, a multi-billion-dollar fraud epidemic, and a legal system that has turned minor fender benders into a lottery ticket. It's a system that, on paper, was designed to protect people, but in reality has created a battlefield where drivers are just collateral damage. To understand it, we have to start with the fundamental structure, which is immediately confusing to most Americans. In the United States, we basically have two flavors of car insurance systems. You either have private companies competing for your business with relatively light government oversight, or in a few states you have government-run insurance. It's one or the other. Ontario tried to do both. Their system is what's called a private/public hybrid. Here's what that means: the insurance itself is sold by private companies, names you might even recognize like Aviva, Intact, or subsidiaries of American giants. They set up shop, they run commercials, they compete for customers just like Geico or Progressive. But, and this is a massive but, they operate under the thumb of the provincial government. An agency called the Financial Services Regulatory Authority of Ontario, or FSRA, dictates almost everything. They approve every single rate change. If a company wants to raise its prices by even 2%, it has to submit a mountain of paperwork and statistical justification to this government body, which can then say yes, no, or come back with a different number. Now, to an American, this might sound great at first. A government watchdog, protecting consumers from greedy corporations. That's the theory anyway. The reality is far messier. This structure creates a bizarre political pressure cooker. Insurance companies claim they're losing money hand over fist because of fraud and litigation costs, and they need to raise rates just to stay afloat. On the other side, politicians know that voters absolutely hate rising insurance costs. It's a political hot potato, so the government is constantly trying to suppress rate increases to keep voters happy, while the insurance companies are screaming that they're being forced to operate at a loss. Think about the dynamic this creates. It's not a free market where competition drives prices down. Instead, it's a slow bureaucratic dance. It means that when costs for things like auto parts, labor, and medical care skyrocket, like they have everywhere recently, insurers in Ontario can't just adjust their prices in real time like they can in, say, Arizona. They have to wait months, sometimes years, for government approval. So what do they do in the meantime to stop the bleeding? They become incredibly, brutally selective about who they're willing to insure. They tighten their underwriting rules to a razor's edge. They look for any possible reason to label a driver as high risk and either charge them an astronomical rate or refuse to cover them at all. This is the first critical lesson for the American driver. Look at your own state. You might think you're in a purely private free market system. But how much influence does your state's Department of Insurance have? Do they have a rate review board? Are there state-mandated coverages that force insurers to include things you might not even want or need? The more government regulation that gets layered on top of a private system, the less flexibility that system has. It can create unintended consequences, where instead of protecting all consumers, it ends up punishing huge segments of the population, like young drivers, new immigrants, or people living in specific zip codes, by making insurance virtually unaffordable. The Ontario model shows us that the road to sky-high premiums is often paved with good intentions. But this government oversight, this strange public-private tug-of-war, is only the stage. It sets the scene for the real drama. The core of the problem, the engine of the entire crisis, is a single, widely misunderstood concept. It's a two-word phrase that exists in many U.S. states, including Florida, Michigan, and New York, but has been twisted in Ontario into something entirely different. It's a concept that was designed to make accident claims faster, fairer, and less contentious, but has instead spawned a billion-dollar industry of legal battles and medical disputes, all funded by the premium of every single driver. That concept is no-fault insurance. And the way it works just across our northern border is a masterclass in unintended consequences. Understanding it is the key to unlocking not only why a Canadian pays so much, but it also reveals the single most important, and most frequently ignored, clause that could be hiding in your own auto policy right now, waiting to turn your minor accident into a major financial nightmare. And to understand that clause, we first need to understand the battlefield on which it was created. Welcome to the Greater Toronto Area, or the GTA. For most Americans, Toronto is that clean, friendly city with the big tower. But for insurance companies, and for the people who live there, certain parts of it are a financial war zone. The reason why comes down to two words that are almost taboo in the American insurance industry, but are an accepted, brutal reality in Ontario: postal code discrimination. Imagine this. You live on Main Street. Your friend lives on Oak Avenue, literally 2 blocks away, just across a municipal line. You both have the exact same driving record, perfect. You drive the same 2022 Toyota RAV4. You're the same age, same gender, same everything. Yet, your insurance premium is $2,000 a year higher than your friend's. Not because of anything you did, but simply because of the 6 characters in your postal code. That isn't an exaggeration. That is the daily reality for millions of drivers in Ontario. Certain cities like Brampton, Vaughan, and parts of Toronto have become notorious black holes for insurance costs, with premiums easily double or triple what someone pays just a 30-minute drive away. So the first, most obvious question is, why? Are people in Brampton just inherently worse drivers? Of course not. The answer is a toxic cocktail of 3 ingredients: density, infrastructure, and the big one, fraud. First, density. The GTA is one of the fastest-growing regions in North America. More people, more cars, all crammed onto highways that were designed decades ago. It's simple math. The more cars you have packed into a small space, the more chances they have to bump into each other. More bumps mean more claims. More claims mean higher costs for insurers. Those costs get passed directly to the consumer. It's the same reason a driver in rural Wyoming pays a fraction of what a driver in Los Angeles pays. But in Ontario, this effect is amplified to an extreme degree. Second, infrastructure and legal systems. The way Ontario's system is set up involves a complex mix of private insurance and government regulation. After an accident, there are specific, often lengthy, processes for claims, disputes, and potential lawsuits. This system, while intended to be fair, can also be slow and expensive to navigate. Every legal letter, every medical assessment, every hour a lawyer bills, adds to the total cost of a claim. A simple fender bender that might be settled for a few $1,000s in some jurisdictions can spiral into a tens of thousands of dollars affair involving multiple assessments and legal wrangling. Again, who pays for that systemic overhead? The driver. But the real catalyst, the ingredient that turns a costly system into a financially ruinous one, is fraud. We're not talking about someone slightly exaggerating their whiplash. We're talking about organized crime. Sophisticated, multi-million-dollar rings that stage accidents, create phantom injuries, and exploit loopholes in the medical and legal systems to drain insurance companies dry. Here's how a typical scenario plays out. A criminal ring will have a team of people: the drivers, the victims, and connections at medical clinics and legal offices. They'll target an innocent driver on a busy road. One of their cars, the blocker, will pull in front of you. Another, the swooper, will cut in front of the blocker and slam on their brakes. The blocker then slams on their brakes, and you, with no time to react, rear-end them. It looks like a simple, clear-cut case of you being at fault. Suddenly, the car you hit, which had only a driver, now has 4 people inside, all complaining of severe neck and back pain. An ambulance is called. They are all taken to a specific clinic, a clinic that is in on the scam. There, they undergo months of unnecessary treatments, therapies, and assessments, with every single service billed back to your insurance company. The clinic gets a cut, the lawyers handling the victim's injury claims get a cut, and the criminals orchestrate the whole thing. A minor collision that should have been a $5,000 bumper replacement has now morphed into a $250,000 mega claim, fueled by fraudulent medical expenses and injury settlements. And these aren't isolated incidents. Law enforcement and insurance investigators have uncovered rings that have run these scams for years, siphoning hundreds of millions of dollars out of the system. So what does an insurance company do? They can't just stop insuring people in Brampton. The government won't let them. So they do the only thing they can. They look at the data. They see that an astronomical number of these fraudulent claims originate from a few specific postal codes. Their response is cold, hard math. They draw a virtual line around those areas and jack up the rates for every single person inside that line. They are, in effect, forcing the honest people in the community to subsidize the cost of the criminals operating among them. The good driver, the person who has never had an accident, who follows all the rules, is punished for the sins of the fraudster who lives down the street. It's a brutal and, many would argue, deeply unfair system. But from the insurance company's perspective, it's a matter of survival. They are bleeding money in these territories, and they have to stop the bleeding somewhere. This intense pressure cooker environment, high-density traffic, expensive legal systems, and rampant organized fraud has forced insurance companies in Ontario to become incredibly meticulous. They have been burned so many times for so much money that they have started fortifying their policy documents. They've begun adding clauses and conditions that are laser-focused on limiting their risk and exposure. They're looking for any possible way to deny a claim that smells even remotely suspicious or that falls outside the absolute strictest interpretation of the policy. And this is where it comes back to you. Because the strategies and the language they use to protect themselves in the fraud capital of Canada don't just stay in Canada. Insurance companies are global. They share data, they share strategies, and they share lawyers. A clause that proves effective at shutting down a $1 million fraudulent claim in Toronto is an incredibly valuable tool. A tool that can be quietly adapted, tweaked, and inserted into a policy in Ohio, in Texas, and California. It's a microscopic change in wording. A single sentence buried on page 17 of a 40-page document. But it's a sentence that fundamentally changes the agreement you think you have with your insurer. It's a sentence designed to protect them from the worst-case scenarios born in places like the GTA. And it creates a trap. A trap that the average honest driver, the person who would never dream of committing fraud, is the most likely to fall into. It's a trap that revolves around the single most common and innocent thing we do with our cars: letting someone else drive them. And the specific name for this trap, the clause that could turn your generosity into your ruin, is known as the unlisted driver exclusion. Now that term, the unlisted driver exclusion, it sounds like dry, boring legal jargon. The kind of thing you'd find buried on page 37 of a document you never read. And that's exactly the point. It's designed to be overlooked. But in practice, it's less like a clause and more like a landmine, silently waiting for one specific, common act of kindness. To understand its devastating power, let's imagine a scenario. Let's talk about a guy named Michael. Michael lives in a suburb of Toronto. He's a responsible guy, pays his bills on time, has a good job, and of course he has car insurance. He pays a hefty premium every month, just like millions of others in Ontario, assuming he's covered. He has a 2021 Honda CR-V. Nothing fancy, just a reliable family car. One Saturday, his cousin Sarah is in town from Buffalo, New York. She flew in but needs to run a quick errand to pick up a cake for a family dinner. It's a 10-minute drive to the bakery. Michael, without a second thought, does what any of us would do. He says, "Just take my car. and tosses her the keys. It's an act of convenience, of family courtesy. What could possibly go wrong? Sarah is a great driver. She has a perfect record back in New York. She gets in the CRV, adjusts the mirrors and heads off. 5 minutes later, she's sitting at a red light, waiting patiently. Suddenly, a commercial van, whose driver is texting, slams into the back of her. The impact is violent. It shoves Michael's CRV into the intersection, where it's then T-boned by a pickup truck that had the green light. It's a catastrophic multi-car pileup, and it was 100% not Sarah's fault. The aftermath is a mess. The CRV is totaled. The driver of the pickup truck has a broken arm and a concussion. The van driver who caused it all? He has insurance, but it's the bare minimum commercial policy. It's not going to be nearly enough to cover the extensive damages and injuries. But that's okay, right? This is exactly why Michael pays for good insurance. He has collision coverage to replace his car, and he has $1 million in liability coverage to protect him in case of something just like this. He calls his insurance company, explains the situation, and starts the claim. The agent on the phone is polite, takes all the details, and says they'll be in touch. A week later, Michael gets a letter in the mail. It's not a check. It's not an update. It's a denial. A full, complete, unequivocal denial of the entire claim. The letter states that because the driver of his vehicle at the time of the accident, his cousin Sarah, was not listed on his policy, they are invoking the unlisted driver exclusion. They will not be paying to replace his $25,000 CRV. They will not be covering any of the medical or legal claims from the injured truck driver. Michael is on his own. He is completely financially exposed. His world just imploded because of a 10-minute drive to a bakery. Now, if you're listening to this from anywhere in the United States, your brain is probably short-circuiting right now. You're thinking, that can't be right. That's not how insurance works. And you're correct. In the vast majority of the US, a principle called permissive use is the standard. It means if you give someone permission to drive your car, your insurance covers them, plain and simple. Your policy follows your car. If your cousin from out of town borrows your Ford Explorer in Ohio to go to the store and gets in an accident, your insurance company might not be thrilled, but they'll cover the claim. It's the bedrock assumption of American auto insurance. But Ontario is different. In Ontario, the policy follows the driver. Or more accurately, it only follows the drivers listed on the policy. The unlisted driver exclusion, sometimes officially known as the OPCF 28A in Ontario insurance documents, is an optional endorsement that many drivers have on their policy, often without even realizing it. They select it or it's recommended by their broker for one simple reason. It saves them money. By signing it, you are making a legally binding promise to your insurance company. You are saying, I swear that absolutely no one will drive my vehicle except for the specific people I have named on this policy. In exchange for that promise, the insurer gives you a discount on your premium. From the insurance company's perspective, this makes perfect sense. They want to know exactly who they are insuring. They want to assess the risk of every potential driver. They don't want you paying a low premium for yourself, a 50-year-old with a perfect record, while secretly letting your 19-year-old son with 2 speeding tickets drive the car every weekend. The exclusion is their tool to prevent that kind of fraud or misrepresentation. The problem is, it's a sledgehammer used to crack a nut. It doesn't distinguish between a fraudulent long-term arrangement and a one-time innocent act of kindness. To the insurance company, Michael letting his cousin Sarah drive to the bakery is the same as him hiding a high-risk driver. The context doesn't matter. The promise was broken. The contract is void. So let's go back to Michael. He's staring at this denial letter, his heart pounding in his chest. He still owes $12,000 on his car loan for a vehicle that is now a twisted wreck in an impound lot. But that's the least of his worries. The driver of the pickup truck who was T-boned is now suing. He's suing the van driver who caused the crash, but he's also suing the owner of the car that hit him, Michael. His injuries, lost wages, and pain and suffering are adding up to a claim of over $500,000. Normally, Michael's insurance company would step in here. They would provide lawyers, defend him in court, and pay out any settlement or judgment up to his $1 million liability limit. This is the fundamental promise of liability insurance, to protect your assets, your house, your life savings, from a disastrous lawsuit. But because of the unlisted driver exclusion, his insurance company has washed its hands of the situation. They send another letter stating that they have no duty to defend him. He has to hire his own lawyer out of his own pocket. And if he loses the lawsuit, that $500,000 judgment is his and his alone to pay. This is the trap. It's a financial doomsday machine hidden in plain sight. Michael, a man who thought he was fully protected, is now facing financial ruin. He could lose his house, his savings, everything he's ever worked for. His wages could be garnished for the rest of his life. And it all started because he tossed his car keys to his cousin. This isn't some far-fetched one-in-a-million scenario. This happens. People in Ontario lose everything because of this single clause. It turns a simple favor into a game of Russian roulette with your financial future. It forces people to make a cold, calculated risk assessment before doing something as simple as letting a friend drive them home when they've had a drink, or letting a visiting relative use the car for an afternoon. You have to ask yourself, is this 10-minute trip to the bakery worth risking my house? For our American audience, this is a profound, almost unbelievable difference in the fundamental nature of car insurance. It highlights a system that prioritizes the insurer's ability to calculate precise risk over the consumer's reasonable expectation of coverage in everyday situations. Michael is now in an impossible position. The law seems clear. The policy he signed seems clear. The insurance company, a multi-billion-dollar corporation with an army of lawyers, has made its decision. To them, it's just business. To Michael, it's the end of his world. He's staring into a financial abyss with no apparent way out. He followed the rules, he paid his premiums, and in his moment of greatest need, the system he trusted has utterly abandoned him. But what Michael doesn't know, and what the insurance company is counting on him not knowing, is that the story isn't quite over. Buried deep in Canadian case law, there is a sliver of hope, a legal argument so nuanced, so specific that it rarely sees the light of day. A counterintuitive principle that challenges the very foundation of the unlisted driver exclusion. And it all hinges on the legal definition of one simple word: consent. So what does consent actually mean? In our everyday lives, it's simple. Yes or no? Did you give permission? Did you say it was okay? We think of it as a direct, explicit action. I consent to you borrowing my pen. I do not consent to you borrowing my car. But in the labyrinth of Ontario's Insurance Act, the word consent is not a simple light switch, either on or off. It's a dimmer. It has gradients, can be implied, can be assumed, and most terrifyingly for insurance companies, it can be transferred. This is where the entire case pivoted. Not on the son, the unlisted driver who caused the accident, but on the father, the policyholder. The insurance company's argument was clean, simple, and powerful. The son was explicitly excluded. The father knew this. The son drove anyway. Therefore, the father, by allowing the son access to the keys, violated the terms of the policy. Claim denied. It seems open and shut. And in many jurisdictions in the United States, that would be the end of the story. The exclusion clause is king. But the family's lawyer wasn't looking at the exclusion clause anymore. He was looking at a different, much older part of the law, Section 192 of Ontario's Highway Traffic Act. This isn't the Insurance Act. It's the law that governs the roads themselves. And it contains a concept that lawyers call vicarious liability. In simple terms, it means the owner of a vehicle is liable for what happens with that vehicle, even if they aren't the one driving it, if the person driving it has possession of it with the owner's consent. Now you're probably thinking, wait a minute, the father didn't consent. He told his son not to drive. And you're right, he did not give express consent. But the courts in Ontario have for decades wrestled with a thorny question. What if you consent to one thing and that leads to another? Let me give you an example. Let's say you loan your car to your trusted friend, Sarah, to go pick up groceries. You've given her consent. She has the keys, she has your permission. She drives to the grocery store, but on the way she feels unwell. She calls her husband, Tom, to come meet her and drive the car home for her. Tom gets in your car and on the way home he gets into an accident. Tom is a safe driver, but he's not listed on your policy. He's not Sarah. Will your insurance cover the damage? The insurance company might try to argue that you never consented to Tom driving. You consented to Sarah driving. But the courts in Ontario have often taken a different view. They've established a two-part test. Part 1. Did the owner give consent for the vehicle to be in the possession of the first person? In our example, yes. You gave the car to Sarah. Part 2. Did the second driver, in this case Tom, believe they had a reasonable right to drive the vehicle, based on the permission granted by the first person? Sarah, feeling unwell, asked her husband to drive. It's reasonable for Tom to believe he has her permission, and by extension, a form of consent that traces back to you. This is the chain of consent theory. It's the idea that when you hand over your keys, you're not just consenting to a person, you're consenting to a situation. You are transferring a degree of control. Unless you put very specific, very clear limits on that consent. Sarah, you and only you can drive this car, and only to the grocery store and back. The law might interpret your consent more broadly than you ever intended. Now let's apply this mind-bending logic back to our family's nightmare. The father told his son, "You are not to drive this car." That sounds like a specific, clear limit, right? But the insurance company's own investigation revealed a crucial detail. While the father had forbidden the son from driving, he hadn't taken away his keys. The son still had a key on his keychain. He still lived in the house. The car was still in the driveway. The family's lawyer seized on this. His argument was no longer about the son, it was about the mother. Remember, the father had gone out of town on business. He had left the car and its keys with his wife. He had given his wife, the other named driver on the policy, full, unrestricted possession of the vehicle. He gave her his consent. Did the father say to his wife, "Honey, you can drive the car, but under no circumstances can you let our son drive it, even in an emergency?" No. Like any normal couple, he just left. He trusted her. So now the legal chess game begins. Step 1. The father gives the mother consent to possess the vehicle. That's a fact. Step 2. The mother, facing an emergency with her daughter's health, asks the son to drive to the pharmacy. In that moment of panic, she gives the son consent. Step 3. The son now has possession of the vehicle with the consent of someone who had the owner's consent. Do you see the chain? Father consents to mother. Mother consents to son. The lawyer's argument was that the original consent given by the father to the mother was broad and unrestricted. He didn't place any limits on who she could allow to drive in an emergency. Therefore, the son was, through this legal chain of logic, operating the vehicle with the owner's implied consent. And if consent exists, even this fragile implied two steps removed kind of consent, then Section 192 of the Highway Traffic Act kicks in. The owner is liable. And if the owner is liable, the insurance policy attached to that owner and that car is supposed to respond. The argument was that this statutory obligation, this public policy to protect victims on the road, was so strong that it could actually override the unlisted driver exclusion written in the fine print of the insurance contract. This is a bombshell legal argument. It's like finding a secret passage in a castle. You're telling the insurance company, "Yes, your contract says this. Your exclusion is written right here in black and white." But there's a higher law. The law of the land, the Highway Traffic Act, creates a responsibility that your contract cannot erase. For an American audience, this might sound, well, insane. In the US, the contract is typically paramount. An exclusion is an exclusion. If you sign a document that says person X is not covered, and person X drives and crashes, the discussion is usually over. The idea that a broader, societal law about road safety could reach in and nullify a specific clause in a private contract is a fundamentally different way of looking at insurance. It frames insurance not just as a private agreement between you and a company, but as a component of a public safety net, governed by principles that sometimes transcend the contract itself. The family's lawyer wasn't just arguing for his clients. He was making a statement about the nature of insurance in Ontario. He was forcing the court to ask a fundamental question. What is the primary purpose of mandatory auto insurance? Is it to protect the assets of the insurance company by enforcing tightly written contracts? Or is it to protect the public, to ensure that an innocent person hit by a car isn't left financially ruined because of a technicality in the driver's policy? The insurance company, of course, saw this argument as a desperate, last-ditch effort, a legal Hail Mary. Their lawyers prepared to dismantle it, piece by piece. They would argue that the father's verbal prohibition to his son was a clear limit. They would argue that the mother knew the son was excluded and that her consent was therefore invalid, given under duress and against the explicit rules of the policy she shared. They would argue that allowing this chain of consent theory to override a clear exclusion would open the floodgates. It would mean that unlisted driver exclusions were essentially meaningless. Anyone could let anyone drive. And as long as you could construct some flimsy story about implied consent, the insurer would be on the hook. It would create chaos, they argued. It would make insurance rates for everyone skyrocket. The stage was set for a legal battle that would go far beyond one family and one accident. It was a clash of philosophies, contract versus statute, Private agreement versus public good. The family, emotionally and financially drained, now had a glimmer of hope, but this hope rested on a complex, nuanced legal theory that had only been successful in a handful of very specific cases. Their lawyer had found the path, but the path was uphill, through a storm, and guarded by a dragon with very deep pockets. And the insurance company's counterattack wouldn't be just about the law. They were about to make it personal. They were going to dig into the family's life, their history, their relationships, to prove that this wasn't about implied consent at all. It was about something much simpler. A deliberate deception. The insurance company's lawyers started by pulling a single innocuous thread. The application form. The one Mr. and Mrs. Singh filled out years ago. A simple document, a few pages of checkboxes and signature lines. To the family, it was a memory of a Tuesday afternoon. A chore to get done. To the lawyers, it was a legal contract, a sworn statement. And on that statement, under the section for listed drivers, there were two names. Husband and wife. The son's name was not there. This, they decided, was not an oversight. It was the cornerstone of their new strategy. The legal term for it is material misrepresentation. It's a phrase that sounds dry and academic, but in the world of insurance, it is a weapon of absolute destruction. It means you didn't just make a mistake. You lied about something so important, so fundamental, that if the insurance company had known the truth, they never would have given you the policy in the first place. Or, at the very least, they would have charged you a much higher premium. And in Ontario, having an unlisted, regular driver under the age of 25 in the household? That is the definition of a material fact. The lawyers for Intact Insurance were no longer investigating a car crash. They were now investigating a family. The mission was simple. Prove that the son wasn't just a visitor who borrowed the car once. They had to prove he was a regular and frequent driver who, for all intents and purposes, lived at that address, making him a de facto unlisted operator. The first wave of the investigation was digital. They subpoenaed cell phone records. Not for the content of the calls, but for the metadata. The data that tells a story nobody thinks they're telling. They wanted to see which cell towers the son's phone was pinging off of day after day, night after night. Was he consistently pinging the tower closest to his parents' home between midnight and 6 a.m.? That's not a visitor. That's a resident. They cross-referenced his phone records with his parents. Were there hundreds of calls between them? Or very few? After all, you don't typically call people you live with. You talk to them over the dinner table. Then they went to social media. An army of paralegals and junior investigators were tasked with a singular purpose: to digitally excavate the son's life. They scrolled back months, then years through his Instagram, his Facebook, his Twitter. They weren't looking for party photos. They were looking for patterns. Geotags placing him at the family home on a random Tuesday. A picture of the family dog with the caption, "Good to be home." A comment from a friend saying, "Hey, you still living at your parents' place to save cash?" Every post, every tag, every seemingly innocent check-in was screenshotted, cataloged, and added to a growing mountain of evidence. Think about your own life for a second. The pictures you post online, the casual comments you make. You probably think of it as a scrapbook, a way to connect with friends. To an insurance investigator, it's a sworn deposition you didn't even know you were giving. They're not your friends, they're anthropologists studying your every move, looking for the one inconsistency that will unravel your entire claim. The digital deep dive was just the beginning. The next step was to make it physical. They pulled financial records. Where was the son's bank statement mailed? His credit card bill? His student loan correspondence? Did he use his parents' address for his Amazon deliveries? For his Uber Eats account? Each piece of mail, each package delivered to that address with his name on it, was another brick in the wall they were building against the family. Paints a picture, you see. A picture of a young man deeply enmeshed in the life of that household. Not a guest, not a relative stopping by for the weekend. And then came the most invasive part of all. They hired a private investigation firm. Men in unremarkable sedans began parking down the street from the Singh's home. They took pictures. They noted when cars came and went. They were building a timeline, a pattern of life. They documented the son leaving for work in the morning and coming back in the evening. They noted he used a key to get in the front door. After a week of quiet surveillance, the investigators got out of their cars. They started knocking on doors. They spoke to the neighbors. Imagine this. Your neighbor, the one you waved to while getting the mail, is being interviewed by a sharp-looking man in a suit holding a clipboard. He's asking questions about you, about your son. Hi, I'm with a research firm. They might say, keeping it vague. We're just doing a survey in the area. You know the family at number 42? The Singhs? Oh yeah, great people. Do they have kids? A son, you say? About what age? Does he live there? Oh, he does. What kind of car does he usually drive? Every casual confirmation from a well-meaning neighbor was a nail in the coffin. Oh yeah, the boy's always here. I see him washing his car in the driveway on Saturdays. He helped me with my groceries last week. These neighbors weren't being malicious. They were just being neighborly. They had no idea that their friendly observations were being weaponized, twisted into proof of a calculated multi-year fraud. For the Singh family, the world began to shrink. The claim for a few $1,000s to fix a bumper had metastasized into an existential threat. They felt watched. Their friends would call, "Hey, some guy came by asking about your son." They started to second-guess everything. Every form they'd ever filled out. Every conversation they'd ever had. The presumption of innocence was gone. They were no longer a family dealing with the aftermath of an accident. They were suspects in a white-collar crime, and their own insurance company was the prosecutor. The final piece of the puzzle for Intact's lawyers came from the son's own employer. A simple request for his employment file. And there it was on his hiring paperwork filled out 2 years prior. Under current address, he had listed his parents' house. It was a simple, practical decision for him at the time. It was where he got his mail, where he slept most nights. He didn't think twice about it. But to the insurance company, this was the smoking gun. This was irrefutable proof in his own handwriting that he considered his parents' address his primary residence. With their case now airtight, the lawyers for Intact Insurance made their move. They sent a letter to the Singh's lawyer. It wasn't a negotiation. It was a declaration of war. The letter stated that based on their investigation, they had concluded that the family had committed a material misrepresentation on their initial application and on every subsequent renewal. They had failed to disclose a primary driver who resided in the home. And because of this, the insurance company was exercising its right under the law to do something truly terrifying. They were voiding the policy ab initio. From the beginning. This is the nuclear option in the insurance world. It doesn't mean they're just denying this one claim. It means they are retroactively erasing the entire insurance policy from existence. Every premium payment the Singh family had faithfully made for years was to be returned. And in exchange, it was as if they had never, ever been insured by Intact at all. The safety net they had paid for year after year was not just gone. The insurance company was arguing it had never been there in the first place. The implications were staggering. They were now personally on the hook for the full cost of the other driver's repairs. They were on the hook for the other driver's medical bills, rental car, and any potential injury lawsuits. And of course, their own car was a total loss they would have to eat themselves. The initial claim of a few $1,000s had just exploded into a potential liability of hundreds of thousands of dollars. They were alone, completely exposed, and facing financial ruin, all because their son had come home for dinner. The letter from the other driver's insurance company wasn't just a letter. It was a declaration of war. It stated in no uncertain terms that since David and Sarah's own insurance had denied the claim, they, the other company, were now looking to David and Sarah personally to cover the full extent of their client's damages. The medical bills, the lost wages, the future care costs, the pain and suffering. The number they floated was $250,000, with a very clear implication that it could go much, much higher. This is where the American dream curdles into a nightmare. You work your whole life, you build a home, you save for retirement, and in the span of a single afternoon, one brief, catastrophic event threatens to wipe it all away. Their son Michael was beside himself with guilt. He had a clean record, he was a good kid, but he had made a mistake. A simple human mistake. He hadn't seen the other car. And now, that split-second error was about to bring his parents' world crashing down. Their first call was to a lawyer. Not an insurance lawyer, but a litigation attorney. Someone who fights in the trenches. The lawyer listened patiently, reviewed the denial letter from their insurer, and then gave them the cold, hard truth. Their insurance company was likely within its rights. The policy was an ironclad contract, and by not having Michael listed as a regular driver, even though he lived elsewhere, they had technically violated the terms. The clause about permissive use was designed for rare, one-off situations, not for a family member who drove the car with any regularity, even if it was just on weekend visits. The insurer's argument was simple. They hadn't collected a premium for the risk Michael represented, so they weren't going to cover the loss. But the lawyer then explained the real monster in the room, the legal doctrine that was about to haunt them. Vicarious liability. It's a concept that exists in both the US and Canada, but its application can be worlds apart. In simple terms, it means one person can be held responsible for the actions of another. A classic example is an employer being liable for the negligence of an employee. But when it comes to vehicles, it gets messy. In their state, like many others, there's a version of what's called the negligent entrustment rule. To hold David and Sarah liable, the other side would have to prove that they knew or should have known that their son was a reckless or incompetent driver when they handed him the keys. Given Michael's clean record, that would be a tough case to make. This was their glimmer of hope. Their lawyer believed they could fight it. They could argue that they had no reason to believe their son was a risk. They could argue that this was a simple accident, and the liability should rest with the driver, Michael, not with them. But fighting costs money. A lot of money. Tens of thousands of dollars in legal fees just to get started. And there was no guarantee of winning. They would be David and Sarah, a retired couple with a fixed income, against the full legal might of a multi-billion-dollar insurance corporation. Now let's pause their story right there at the edge of that financial abyss and look north to Ontario. Because what happened to David and Sarah is precisely the kind of scenario that the Ontario auto insurance system is designed to handle, but in a completely different and arguably more brutal way for the vehicle owner. This is fundamental to understanding why Ontario rates are what they are. In Ontario, they don't just have a vague concept of vicarious liability for vehicle owners. They have it written into law black and white with very few ways out. It's called the Highway Traffic Act, and Section 192 is the hammer. It states, and I'm paraphrasing here, that the owner of a motor vehicle is liable for loss or damage sustained by any person by reason of negligence in the operation of the motor vehicle, unless the motor vehicle was without the owner's consent in the possession of some person other than the owner. Let that sink in. In Ontario, if you own the car, you are on the hook. Period. It doesn't matter if you knew the driver was risky. It doesn't matter if they have a perfect record. If you gave them consent to drive your car, explicitly or implicitly, and they cause an accident, you are just as liable as they are. The victim's lawyers don't have to prove you were negligent in lending the car. They just have to prove you own it, and you consented to its use. This single piece of legislation fundamentally changes the entire insurance equation. It's why in Ontario the question "who will be driving this car?" is not a casual inquiry. It is the absolute core of the risk assessment. The insurer isn't just insuring you, the policyholder. They are insuring every single person you might possibly let get behind the wheel, because the law ties the owner to the driver with a chain of absolute liability. So, if David and Sarah had lived in Toronto instead of Toledo, the sequence of events would have been terrifyingly different. Their insurance company would not have been able to simply deny the claim based on Michael not being listed. Why? Because the law would have dragged them into the lawsuit anyway. The victim's lawyer would sue both Michael as the driver and David and Sarah as the owners. Their insurance company, knowing this, would be forced to step in and defend them, because their policy covers their liability as owners. But here's the catch. They would still be in a world of trouble. The insurance company would defend the claim. Yes, but they would immediately turn around and sue David and Sarah for breach of contract. They would argue that David and Sarah misrepresented the risk by not disclosing their son as a regular driver. The insurer would say, "We will pay the victim because the law says we have to protect you, the owner. But you violated our agreement, so you're going to pay us back every single penny." So in the US scenario, they are left to fight the victim alone. In the Ontario scenario, the victim gets paid, but the insurance company comes after the parents to get their money back. Two different paths that both lead to potential financial ruin. This strict owner liability is a massive factor driving up premiums in Ontario. Insurers have to price in the risk that a car owner will lend their vehicle to a high-risk friend, a visiting relative, or a child who isn't on the policy, and that a single accident could result in a $1 million claim that the law forces them to be a part of. This is also why the concept of unlisted drivers is so aggressively pursued by Ontario insurers. They conduct investigations after claims, checking social media, interviewing neighbors, trying to determine if a driver who got in an accident was, in fact, a regular undisclosed user of the vehicle. It feels invasive, it feels predatory, but from their perspective, it's about enforcing the contract to protect themselves from the immense liability imposed on them and their clients by the Highway Traffic Act. Back in the United States, David and Sarah were preparing for the fight of their lives. They took out a second mortgage on their home to pay the lawyer's retainer fee. Every mail delivery brought a fresh wave of anxiety. They were having trouble sleeping. Their retirement, which was supposed to be about peace and relaxation, had become a waking nightmare of legal documents and financial dread. Their lawyer was building a case, focusing on the ambiguity of permissive use, and the fact that their insurance agent had never explicitly warned them about this specific scenario. It was a long shot, but it was the only shot they had. Meanwhile, the other driver's condition had worsened. Complications from surgery meant a longer hospital stay and a more arduous, expensive recovery. The initial estimate of $250,000 was starting to look optimistic. The other driver's insurance company sent a formal offer to settle, a demand letter. They wanted David and Sarah to sign over the deed to their house and liquidate a significant portion of their retirement savings. In exchange, they would consider the matter closed. It wasn't an offer. It was an execution order for their financial future. They were given 30 days to respond. The clock was ticking, and with every tick, the life they had built was closer to being dismantled piece by painful piece. 30 days. Not a month. 30 precise, calculated days. In that moment, the world didn't crash down around them in a cinematic explosion. It just stopped. The hum of the refrigerator, the distant sound of kids playing outside. The very air in the room became thick, heavy, and silent. They read the letter again and again, as if a different combination of words would magically appear on the page. But the language was cold, brutally clear, and meticulously crafted by a team of lawyers whose only job was to protect the insurance company, not them. The company they had faithfully paid on time every single month for over a decade. The company whose catchy jingle promised they were in good hands, that they were a good neighbor. Right now, that neighbor was standing on their lawn with a foreclosure sign. Their first call wasn't to a friend or a family member. How could you even begin to explain this? How do you say, "We might lose everything because of a fender bender from 2 years ago"? No, the first call was a frantic, desperate search for a lawyer. Not just any lawyer. They needed a specialist, someone who understood the arcane, labyrinthine world of insurance litigation in Ontario. The first few calls were dead ends. "We don't handle that." Or "That's a very specific field," they were told. Each rejection felt like another door slamming shut, locking them in a room with a ticking bomb. Finally, they found him. An older lawyer, recommended by a friend of a friend, with a reputation for being a bulldog, for taking on the Goliaths of the insurance industry. His office wasn't a sleek downtown tower of glass and steel. It was a modest, book-filled space that smelled of old paper and strong coffee. He didn't offer platitudes or comforting lies. He read the letter, his face an unreadable mask, and then looked at them over the top of his glasses. "They're throwing you to the wolves," he said, his voice a low gravel. "This isn't an offer. This is a strategic retreat." He slid the letter across his mahogany desk. "Let me explain what this piece of paper actually is. Your insurance company is legally obligated to defend you against this lawsuit. They hired a lawyer, they've been going through the motions. But the plaintiff's demand is for $2 million. Your policy limit," he tapped a line in their insurance declaration page, "is $1 million. The company sees the writing on the wall. They think a jury might award the full $2 million. So they have a choice. They can either go to trial and risk having to pay the full policy limit, or they can do this." He gestured at the letter again. "This is called a consent to judgment offer, more or less. They are telling the plaintiff, look, we'll give you our client's $1 million policy limit right now. No more fighting. You just have to get our client, meaning you, to agree to a judgment against you for the full $2 million. We pay our $1 million, we close our file, and we walk away. The remaining $1 million? That's your problem now. You can spend the rest of your lives paying it off." The husband and wife just stared. It was a betrayal so profound it was hard to process. "But they're our insurance company," the wife stammered. "Aren't they supposed to protect us?" The lawyer leaned back in his chair, the old leather groaning in protest. "They are supposed to act in good faith. Their primary duty is to you, their insured. That duty includes taking all reasonable steps to settle the claim against you within your policy limits to protect you from personal exposure. What they're doing here, this is walking a very, very fine line. In my opinion, they're leaping right over it. And this is where the Canadian system, specifically in Ontario, shows its teeth in a way that might seem shocking from a U.S. perspective. In many U.S. states, this scenario would be the opening chapter of a massive bad faith lawsuit against the insurance company. If an insurer has a reasonable opportunity to settle a claim within the policy limits and fails to do so, leading to a judgment against their client for more than the limit, the insurer can often be held liable for the entire judgment, regardless of the policy limit. It's a powerful hammer that keeps insurance companies honest. In Ontario, the concept of bad faith exists, but the path to proving it and the remedies available can be more complex, more fraught with peril. The insurance company knows this. They are making a calculated gamble. They're betting the family will be too scared, too exhausted, and too financially drained to fight back. They are betting that the terror of a $2 million judgment will force them to sign, to agree to this financial execution, just to make the immediate legal battle stop. The lawyer continued. They are putting their own financial interests ahead of yours. They had opportunities to settle this case for the policy limit months, maybe even a year ago. The plaintiff's lawyer would have likely taken the $1 million then. But the company lowballed them. They haggled. They delayed. They played chicken with your financial lives, and now they've lost. But instead of paying the price, they're trying to hand you the bill. He laid out the stark reality. The 30-day clock wasn't just a deadline to respond to the plaintiff. It was a deadline on their own insurance company's offer to abandon them. If they didn't agree, the company would continue their legal defense, but it would be a half-hearted defense at best. They would go to trial, likely lose, and the outcome would be the same. A $2 million judgment. The insurance company would pay its $1 million, and a collection agency would come for the rest. So what do we do? The husband asked, his voice barely a whisper. The guilt was radiating off him. He was the one behind the wheel. He was the one who had, in one brief, unremarkable moment, put his family in this impossible position. We fight, the lawyer said, his tone shifting from academic to strategic. We fight on two fronts. First, we have to deal with this immediate threat. We tell the plaintiff's lawyer, no deal. We will not consent to a judgment. We will force our insurance company to do its job and defend us at trial. We will make it as difficult and expensive for them as possible. He paused, letting that sink in. Second, and this is the long game, we put your insurance company on notice. We send them a letter, a very strongly worded letter, informing them that we consider their actions to be in bad faith. We tell them that they have breached their duty to you, and that if a judgment comes down that's over your policy limit, we will hold them responsible for every single penny of it. We begin building a second lawsuit, not against the other driver, against your own insurance company. The room was silent again, but this time it wasn't the silence of shock. It was the silence of a family staring down a dark, treacherous path. This wasn't a solution, it was a declaration of war. A war against a multi-billion-dollar corporation with endless resources. A war that would consume their time, their emotions, and what little money they had left. They thought back to their life savings, the college funds they had so carefully built for their 2 children, the retirement accounts that were supposed to be their security. All of it was now just a pile of chips on a poker table, and their insurance company was trying to force them to go all in on a losing hand. The lawyer's plan was to grab the table and flip it over, hoping they could survive the chaos that followed. The 30 days were still ticking down, but now each tick wasn't just a step towards ruin. It was a countdown to a choice between guaranteed destruction and a desperate, brutal fight for survival. And for thousands of Ontarians every year, the choice is to fight. They choose to stare into the abyss of a 40, 60, even 100% rate increase and say, no. They choose to look at a claim denial that defies all logic and reason, and they refuse to accept it. But how? How does a single person, armed with nothing but a policy number and a sense of injustice, take on a multi-billion-dollar industry designed from the ground up to wear you down, to confuse you, to make you give up? In the United States, your options are often limited. You can complain to your state's Department of Insurance, which may or may not have the resources or the authority to intervene effectively. You can hire a lawyer, plunging yourself into a potentially ruinous and years-long legal battle. Or you can just switch insurers, hoping the devil you don't know is better than the devil you do. But in Ontario, the battlefield is different. There are rules of engagement, and there are weapons available to the average citizen that simply don't exist in the same way for most Americans. The first step in this fight, the first strategic move, is understanding your primary point of contact, your insurance broker. Now, for many Americans who buy insurance direct from a company like Geico or Progressive, the broker is a foreign concept. But in Ontario, they are central to the entire system. A broker is supposed to be your advocate, your guide through this complicated world. They work for you, not the insurance company. At least that's the theory. The reality is murkier. Because while they represent you, they are paid a commission by the very insurance companies they place you with. This creates an immediate, inherent conflict of interest. Is your broker recommending the best policy for you, or the one that pays them the highest commission? When you call them in a panic about a massive rate hike, are they truly on your side? Or are they more interested in maintaining a smooth relationship with the insurer? The first battle, then, is a battle for information. You call your broker and you don't just ask, "Why did my rate go up?" You ask for specifics. You say, "I need you to send me, in writing, the exact underwriting rules and risk classifications that were applied to my policy to justify this increase." You ask, "Which other companies did you get quotes from for me this year? And what were those quotes?" You are testing their allegiance. A good broker will go to bat for you. They'll call the underwriter themselves, they'll argue your case, they'll reshop your policy across the market to find a better deal. A bad broker will give you platitudes. They'll blame the market. They'll say everyone's rates are going up. And they'll tell you there's nothing they can do. If you get that response, you now know your first ally is compromised. But you've also gathered your first piece of intelligence. The next stage of the fight moves directly to the insurer. This is where most people give up. It's a labyrinth of automated phone systems, call center scripts, and polite but firm refusals. The goal of this stage, from the company's perspective, is attrition. They want you to get frustrated and hang up. But the fighter, the person who refuses to accept destruction, knows this is a test. And you pass the test with one simple, powerful tool: documentation. Every phone call is logged. You write down the date, the time, the name of the person you spoke to, and a summary of the conversation. You don't make angry demands. You make calm, reasonable requests. And you follow up every single phone call with an email. "Dear Sir or Madam, just to confirm our conversation today at 2:15 p.m., you stated that my rate increased due to a change in the risk profile for my postal code. Could you please provide the specific data that supports this change? Thank you." You are building a case. You are creating a paper trail. Each email that goes unanswered, each response that is vague and unhelpful, is another brick in the foundation of your argument. You are demonstrating that you have made a good faith effort to resolve the issue directly, and the company has failed to provide a transparent or satisfactory answer. You are no longer just an angry customer. You are a plaintiff preparing their evidence. After you've exhausted this process, after you've been stonewalled and given the runaround, you escalate. Every insurance company in Ontario is required by law to have an internal complaint process, a designated ombudsman or complaint officer. This is not some low-level customer service manager. This is a formal step. You find their contact information, which is often buried deep on their website, and you send a formal written complaint. You attach your log of phone calls. You attach the chain of emails. You lay out your case logically, without emotion, citing the facts and the company's failure to address them. 9 times out of 10, this is still not enough. This internal officer's job is primarily to protect the company from legal and regulatory risk. They will likely review the file and send you a polished, professional-sounding letter that essentially says, "We've investigated ourselves and found we did nothing wrong." It feels like a final, definitive defeat. The door has been slammed in your face. But this is where the Ontario system reveals its most powerful, and to an American, its most shocking feature. Because that letter of denial isn't the end. It's the key. It's the key that unlocks the next level of the fight. In the United States, this is where you'd be calling a lawyer. But in Ontario, you call the GIO, the General Insurance Ombuds Service. It's an independent, impartial body designed to resolve disputes between consumers and insurance companies. It costs you nothing. It's a non-profit, created by the industry itself to handle these exact situations. You submit your complaint, along with that final letter from the insurer and all the documentation you so carefully collected. Suddenly, the power dynamic shifts completely. The insurance giant, which held all the cards, which could ignore your emails and brush you off on the phone, is now compelled to respond. They have to open their books, not to you but to an impartial adjudicator. They have to provide the GIO with the exact underwriting rules, the data, the internal memos that led to their decision. The corporate fortress you couldn't penetrate is now having its walls rendered transparent by a higher authority. And if the GIO isn't the right place, or if the issue is more systemic, there's another level. A government regulator with real teeth. The Financial Services Regulatory Authority of Ontario, or FSRA. This is the government watchdog. If an insurer is found to be using unfair practices, if their rate setting is discriminatory or not based on approved rules, FSRA can levy massive fines. They can force a company to change its practices province-wide. Think about that from a US perspective. It's like having a special branch of the SEC, but dedicated solely to your car insurance policy, with the power to investigate, mediate, and enforce, all at no cost to you. It's an astonishing level of consumer protection. This is the path of the fight. It's not a single heroic charge, but a slow, methodical grind. It's a war of paperwork, of patience, of procedure. It requires you to be more organized and more persistent than the billion-dollar company you're up against. Most people don't know this path exists. They get the bill, they get angry, they get frustrated, and they give up, accepting the ruinous cost because they believe they have no other choice. But the choice is there. The path is laid out. It's a grueling journey, and victory is never guaranteed. The ombudsman might side with the insurer. The regulator might decide no rules were broken. But for the first time, it's not just your word against theirs. It's your evidence against theirs, judged by a neutral third party. The ticking clock hasn't stopped, but you've thrown a wrench in the gears. You've forced the faceless system to stop and look at you, to justify itself not to its shareholders, but to the very referees who write the rules of the game. The fight has just begun, but now it's a fair fight. And that first step into a fair fight feels strange. It's quiet. For days, maybe a week, the angry emails and frustrating phone calls stop. The silence is unsettling, and you start to wonder if your complaint just vanished into some digital black hole. But then an email arrives. The sender isn't your insurance company. The sender is the Financial Services Regulatory Authority of Ontario, FSRA, the regulator, the referee. The email is formal, professional. It states that they have received your complaint, assigned it a case number, and have formally requested a response from your insurer. This is a seismic shift. You are no longer a customer. You are a complainant. Your premium is no longer a price. It is an exhibit. The insurance company is no longer the house. They are the defendant. They have been given a specific time frame, usually 10 to 15 business days, to provide a senior-level written response not just to you, but to the regulator, addressing every single point you raised. This is the moment the corporation is forced to turn and face you. A compliance officer, someone whose entire job is to keep the company from getting sued or fined, is now reading your story. They are pulling up your file, looking at the notes the call center agent made, listening to the recorded calls, and a knot begins to form in their stomach. Because a customer who knows how to file a complaint with the regulator is not a customer you can ignore. A couple of weeks later, the response arrives, forwarded to you by your FSRA case manager. And it is a masterpiece of corporate deflection. It's dense, filled with jargon about rating territories, actuarial data, and approved rate programs. They'll express sympathy for your frustration, but firmly state that the premium is correct and has been calculated in accordance with our approved rating structure. They might include charts and graphs showing rising claims costs across the province. It's designed to do one thing: make you and the regulator feel like the issue is too complex, too technical, and that you should just accept their expert conclusion. 99% of people stop here. They figure, well, I tried. The government looked at it, the company explained it, I guess that's just the price. They feel defeated by the sheer weight of the bureaucracy. But this is not the end. This is the beginning of the real fight. Because they just handed you the key to unlocking their entire fortress. They used the magic words: approved rating structure. So, you write back to your FSRA case manager. You are polite, you are calm, and you ask a single devastatingly simple question. Thank you for forwarding the insurer's response. They state the premium is correct according to their approved rating structure. To ensure transparency and resolve this matter, could you please compel the insurer to provide the specific page and section number from their government-approved rate and underwriting manual that applies to my specific situation and results in this premium calculation? Now let's pause, because this question is the equivalent of a tactical nuclear strike in the world of insurance disputes. Here in the States, we have departments of insurance in each state that serve a similar function. But the level of transparency and the power of this specific request in Ontario's system is immense. You see, every single insurance company that wants to sell a policy in Ontario has to submit its entire rulebook to the regulator for approval. This isn't a marketing brochure. It's a document that can be thousands of pages long, detailing every single variable, every discount, every surcharge, every exception, and the precise mathematical formula for calculating a premium. This is called the rate filing or the rate manual. It is, for all intents and purposes, the law for that specific company. They are not allowed to deviate from it by a single penny. They can't have an underwriter who's feeling like you're a higher risk. They can't have a computer algorithm that just invents a number. The calculation must trace back step by step to a specific rule in that book they themselves wrote and the government approved. When you ask for the specific page and section, you're not asking for their opinion anymore. You are forcing them to prove their math. You are shining a billion-watt spotlight into the black box. The FSRA case manager takes your request and forwards it to the compliance officer at the insurance company. And somewhere in a downtown Toronto office tower, that officer's heart sinks. They can't just say no. The request is reasonable and central to the complaint. They can't send the whole manual, as it's a proprietary document. They have to go digging. They have to find the exact rule that applies to a driver with your car, your address, your history, your specific set of circumstances. And this is where the system's own complexity becomes its downfall. These manuals are so vast, the rules so intricate, that misinterpretations and errors are not just possible, they're common. A call center agent might have misapplied a rule. A data entry error from years ago might be triggering a surcharge it shouldn't. An automated system might have been programmed with a logical flaw that affects 1 in 10,000 customers, and you just happen to be that one. Another 2 weeks go by. The company's next response is different. The confident, authoritative tone is gone. It's more cautious. They might provide a small excerpt from their manual, often couched in confusing language. As per our manual, Section 4B.1, vehicles garaged in Territory 17 with a prior at-fault claim within 6 years are subject to rating factor 1.85. But you have your file. You have your facts. You look at the rule they sent, and then you see it. Your eyes go wide. The rule says at-fault claim. But your claim from 4 years ago, the one they keep bringing up, was a no-fault claim. A comprehensive claim. Someone hit you in a parking lot. According to their own rulebook, the rule they just sent you as justification, that claim should have zero impact on your premium. It's a single word. At fault versus no fault. But in the cold, hard logic of the rate manual, it's the difference between a clean record and a surcharge. It's the difference between a fair price and exploitation. It was never about market trends or rising costs. It was a simple, profound, and expensive mistake. An error they were either too busy, too lazy, or too arrogant to find when you first called. You take a deep breath. You draft a new email to the regulator. You attach the police report from your old claim. You attach the letter from your previous insurer classifying it as no fault. You highlight the word at fault in the rule they sent you. You don't have to be angry. You don't have to use exclamation points. The facts are the facts. The paper trail is undeniable. You have turned their own rulebook, their own law, against them. You have caught them. You hit send. And the silence that follows is different. It's not the silence of being ignored. It's the heavy-weighted silence of an opponent who knows they've been checkmated. The regulator now has an open and shut case of a licensee misapplying its own approved rates. This is no longer your problem. It's the insurance company's problem. A very, very big problem. Days pass. You check your email constantly. Then one morning it appears. A new message from your FSRA case manager. The subject line is short and to the point. Decision regarding your complaint. Your heart pounds in your chest. You've laid the trap. You've presented the evidence. Now, you're about to find out if the system truly works. You click open the PDF attachment. The formal letterhead of the Financial Services Regulatory Authority of Ontario stares back at you. It's dense, full of regulatory jargon and references to sections of the Insurance Act. But you scan past the preamble, your eyes hunting for the verdict. And then you see it. A sentence clear as day, cutting through the legalese. Upon review of the evidence submitted by both parties, FSRA has determined that the insurer failed to provide adequate and timely justification for the significant premium increase applied to your policy. It continues. The insurer's reliance on a postal code re-rating as a post-facto explanation, without prior notification or clear articulation in the renewal documents, does not meet the standards of transparency required under the Fair Treatment of Consumers Guideline. You read it again, and a third time. It's not just a win. It's a complete validation of your entire argument. Every point you made, every piece of evidence you gathered, every suspicion you had, it's all there reflected back at you in the official language of the regulator. They saw the shell game. They saw the retroactive excuse-making. They saw that the complex algorithm was just a smokescreen for a company that couldn't or wouldn't explain its own math. The decision mandates that the insurer must immediately contact you to remediate the situation, which includes refunding the premium difference you paid under protest, along with any associated interest. The system worked. The little guy, armed with nothing but a spreadsheet, a timeline, and a refusal to be ignored, actually won. A few days later, an email from the insurance company lands in your inbox. Not from the frontline agent, not from the dismissive manager, but from someone in a department you've never heard of. The Office of the Ombudsman. It's a name designed to sound important and impartial, but you know it's just the last line of corporate defense. The email is a masterclass in corporate non-apology. It never says we were wrong. It never says we made a mistake. It uses phrases like in light of the regulator's feedback, and as a gesture of our commitment to customer satisfaction. It informs you that a check for the full amount of the overcharge, plus a comically small amount of interest, is being mailed to your address. It then says, we consider this matter closed. And that's the real lesson here. They didn't learn a thing. They weren't caught being unethical, they were just caught. For them, this isn't a moment for reflection. It's a cost of doing business. They will pay the small fine, close the file, and continue operating the exact same way, because the business model relies on the fact that for every one person like you who fights back, there are 10,000 who won't. 10,000 people who will sigh, accept the nonsensical increase, and just pay it. Because it's easier. Because they don't have the time. Because they don't believe they can win. The company isn't just selling insurance. It's selling apathy. And business is booming. The check arrives a week later. You hold it in your hand. It's for a few $100s. In the grand scheme of things, it's not a lot of money. But it's not about the money. It was never about the money. This little piece of paper is a trophy. It's proof of concept. It's a symbol of a single powerful idea. Accountability. It's a testament to the fact that even the most opaque, intimidating systems have rules. And if you learn those rules better than the people enforcing them, you can make the system work for you. So why did we, as Americans, spend all this time dissecting the auto insurance system of our friendly northern neighbor? Because this story isn't about Ontario. It's not about postal codes or the FSRA. It's about any situation where you, an individual, are up against a large, faceless entity that holds all the cards. This could be your health insurance company in California denying a claim based on a pre-authorization they say you never got. It could be your internet provider in Texas charging you for speeds you're not receiving. It could be a bank in Florida hitting you with hidden fees that were buried in the fine print of a 40-page agreement. The playbook is always the same. They create a system so complex and so full of jargon that you're intimidated into silence. They count on you not knowing the rules. They count on you not knowing who to appeal to. They count on you giving up. What this journey through the Canadian insurance labyrinth has shown us is a universal counter playbook. First, document everything. Every call, every email, every letter. Create a timeline. Note the date, the time, the name of the person you spoke to, and a summary of the conversation. In a world of he said, she said, the person with the spreadsheet wins. Your meticulous records are not just notes, they are evidence. They transform your complaint from an emotional plea into a factual indictment. Second, escalate methodically. Don't jump straight to the top. Follow the chain of command. The frontline agent, their manager, the internal ombudsman. At each stage, you are not just trying to get a resolution. You are building your case. You are collecting rejections. You are demonstrating that you followed their process in good faith and were stonewalled at every turn. This is crucial for when you go to the next step. Third, find the regulator. This is the most important piece of the puzzle. For every powerful industry, there is an oversight body. It might be a state insurance commissioner, the FCC, the Consumer Financial Protection Bureau. These agencies are your secret weapon. They are the referees. Your job is to present them with such a clear, well-documented, and undeniable case that they have no choice but to blow the whistle. You're not asking them to fight your battle for you. You're just handing them the rulebook and pointing to the page the other team ignored. And finally, frame your argument in their language. Don't just complain that your bill is too high. That's subjective. Instead, argue that the company failed to provide clear and timely justification, that their process lacks transparency, that they are not adhering to the fair treatment guidelines laid out in their own industry's code of conduct. You are holding up a mirror and showing them that they are not living up to their own standards, or the standards set by the people who sign their license to operate. This whole experience started with a simple, unsettling feeling. The feeling that a number on a piece of paper didn't make sense. It was a mystery that begged to be solved. And in solving it, we uncovered something far more valuable than a few $100s. We uncovered a blueprint for empowerment. We learned that the impenetrable fortress of corporate bureaucracy has a key. And that key is knowledge. The knowledge that a system exists. The knowledge that it has rules. And the knowledge that you have the right to demand those rules be followed. Whether you're in Toronto, Ontario, or Tampa, Florida, the companies you deal with every day are making a bet. They are betting on your confusion. They are betting on your frustration. They are betting that you'll decide it's just not worth the fight. Your job is to prove them wrong. Look at your bills, your insurance renewals, your phone plan, your credit card statements. Ask the simple questions. Why did this go up? Can you explain this charge to me? Can you show me where in my agreement it says you can do that? 9 times out of 10, they'll give you a scripted, nonsensical answer. But that 10th time, you'll hear a slight hesitation. You'll sense the uncertainty. And that's when you know you're onto something. That's the crack in the armor. And that's when you start documenting. That's when you start your timeline. That's when you start the fight. Not with anger, but with cold, hard, undeniable facts. The world is run by complex systems designed by the powerful for the powerful. But even the most complex systems have pressure points. They have levers. They have rules. And now you know how to find them. You know how to use them. They are betting you won't do the work. The single most expensive thing you can do is to silently accept the first number they give you. The most powerful thing you can do is to look them in the eye and ask that one simple, terrifying question. Show me the math.